Now, the other thing I want to share, which I think is absolutely critical, is how do we address this gap? Well, the one way is these entitlement programs. And so several Republican presidential candidates, Nikki Haley, Ron DeSantis, and Mike Pence, have all publicly stated on the campaign trail that they're promoting programs to cut Social Security benefits for people that are 30 and 40 years old. And here's the response to that. So they've gone out and they've started saying that. A poll was done. And on that poll, 82% of voters oppose the push to cut Social Security for Americans under 50. 82%. So where is this going to take us? This is what is so scary to me, J-Cal. I'm not an American declinist. I believe in the American system. It benefited me and my family. But I do worry that we find ourselves in a whirlpool that is very hard to get out of because the populace says we don't want to make the cuts that are necessary in order for us to save ourselves. That's what's so scary to me. And I've said it before. I think it's worth saying again. That's it. I'm done.
It's not a problem with populism. I mean, the elites are saying it too. There's no appetite in the DNC to cut or reform Social Security. Are you kidding?
It's very unpopular. How do you get elected?
I don't know why those Republicans.
How do you get elected saying?
I hadn't seen that article. I would advise all those campaigns not to touch that rail. They're going to electrocute themselves. I think Trump has the right political instincts on this point, which is you cannot touch Social Security as a single party effort. It has to be bipartisan. And there is no bipartisan will to do anything. So I think you're right about the larger point.
Chamath, your thoughts on Friedberg's manifesto that 80% of the public does not want to cut spending. They're in favor of Social Security for people under 50 years old. And we have $1 trillion in debt payments. And we're in a death spiral because we don't have the will.
We're borrowing $2 trillion. In 180 days, we're borrowing an extra $2 trillion.
That's the real point.
The fiscal end of days.
At the start of the year, the expectation was they were only going to borrow $1.6 trillion for the year. Now we're borrowing $2 trillion in just these 2 quarters.
Let me just state what I think about the downgrade. It's irrelevant. The S&P did it 13 years ago. Fitch is a marginal credit rating agency. They're at a minimum 13 years late. At a maximum, they're just anxiety-ridden like other people are, who are always screaming that the sky's falling. So that's my first point. The second point, and the more important one, is that none of you who are always freaking out about this understand this conversation about relativism. All of these conversations are relative. You deal with them in absolutes. On a relative basis, Japan's debt to GDP is 270% and growing. On a relative basis, our debt to GDP is half of that. We are the most important economic force in the world. It is going to continue to be the most economic force in the world. And all I see actually on every single monetary basis is every other country struggling more than we are. So my question to all of the Chicken Littles is, what do you do if you're a central government where you have to have foreign reserves? Do you all of a sudden double down on the euro? Do you double down in the yuan, which is basically a proxy for doubling down in the US dollar? What are you supposed to do? And I never get a good answer because on a relative basis, the US will still continue to do well. I think that debt to GDP is a red herring for a lot of people. And I think that the way that people run their personal lives, which should take income to debt into consideration, I don't think applies as much to governments. And I think these things are going to march forward as a group. There's not going to be a single G8 country that all of a sudden moves away and starts printing surpluses. It happened almost as an accident, an aberration during the Clinton administration. It'll never happen again. And I think that we shouldn't worry so much because I just don't see an alternative. So instead of telling me how bad this is because you think about your own life and how it would be bad if you had debt to GDP of 100, I get it. As a country, give me the alternative country. But just start with that. Can you answer that question? What is the alternative country?
Yeah, where would you put your wealth if not the dollar?
Well, let me paint a scenario that's not as dire as a collapse of the U.S. dollar as the world's reserve currency. Okay, so on this Fitch ratings...
By the way, that's not what I think happens, right? I think this is just purchasing power goes down. That's it. But go ahead, Sachs.
Relative to who? Be specific.
Relative to anyone.
But what does that mean, relative to anyone?
Let me paint like a non-catastrophic scenario or non-apocalyptic scenario, which is what you saw in this Fitch ratings downgrade is that the bond market did move at the margins. There was a sell-off in the 10-year. And as a result, the 10-year bond yield moved up to 4.2%. So it wasn't a case of everybody shedding all of their US treasuries. It's just that there were market actors at the margins who adjusted their portfolios. Okay, now, Friedberg is saying that the Treasury is going to have to do another $2 trillion bond offering. And we have $1 trillion plus deficits as far as the eye can see. And we've got entitlement liabilities on the horizon and then a political unwillingness to do anything about it. So the deficits are only going to get bigger and bigger. Now, what does that do? It's supply and demand. When the US Treasury needs to keep issuing more and more bonds, at some point, the demand for those things gets incrementally saturated and they have to offer a higher yield. So what happens? Well, the bond rates go up. And so the 10-year goes up, like Friedberg was saying, from 4.2 to somewhere in the 5 to 7% range. And that doesn't mean the US dollar is not the world's reserve currency. It just means that it gets incrementally harder and more expensive to keep financing our debt. Now, what is the result of that? Well, if I, as an investor, could theoretically get 7% from the US Treasury as the risk-free rate, why would I want to take equity risk and put it in the stock market, which historically has yielded somewhere in the 5 to 7% range? So if I can get my 5 to 7% from a risk-free US government bond, of course I'm going to do that. So the discount rate on equities will go up. That means that the stock market on a relative basis will go down.
Risk capital will go down. There will be less risk capital.
Will go down, and there'll be way less risk capital available for things like venture capital and private equity, just risk-taking of all kinds. And so the economy will just grow slower. It's not like there'll be a collapse. It'll just be this huge albatross around the neck of the private sector. And this is called crowding out.
May I give a counter here? I think if you look at the amount of sovereign wealth funds and the investment coming from around the world into U.S. venture capital, that will keep the venture machine cranking here in America. But 3 charts to just look at here. Nick, pull up the first one, the 30-year Fed. So to counter this argument, really the aberration has been 2010 to 2020 when we had, low single-digit mortgages, 3%, 4%. The majority of our lifetime, it was between 5 and 10. And if it sticks up in the 5 to 10 basis, that's what we experienced for most of our life. And then the second chart, this is the lowest unemployment we've had in our lifetimes. If you look at the unemployment rate in the United States, 3.6 is unbelievable. And then combined with it, something we've talked about here for 2 years that we can't understand is when do all these jobs burn off? We peaked, during the post-COVID era at about 11 million job openings. And then, we're still over 9. So there's 2 or 3 job openings for every American who wants to work. And we've shut down the borders largely, even though we have some illegal immigration coming in. It is basically shut down the United States to immigration. It's about a third of what it was before Trump. If we can keep ourselves employed and everybody from the Middle East to Japan to high net worth individuals in Europe are pouring their money into the US venture ecosystem, I think the setup here is we got to control spending, as you've said correctly, Friedberg. We get a little bit of control on spending, hopefully. And then we are going to have to slowly burn off some of this, debt. We can't live with this kind of debt payments.
Here's a little data for you, Chamath. This is from Congressional Research Service off of Fed data. So foreign holdings of U.S. treasuries have declined from 40% to 30% of total treasuries. 70% of treasuries today are held by domestic investors. This is the data that was being described in the Treasury Advisory Committee, the Borrowing Advisory Committee letter that I just said, is that they're seeing less demand from foreign buyers of treasuries. Now, we can argue theoretically about what else are they going to buy and what else are they doing with their money. I don't know. But the data is showing a decline in purchasing intention by foreign buyers of U.S. treasuries. And we're having to pick up the slack through investment funds held by the U.S., mostly pension, mostly retirement funds, I would guess, that are buying these treasuries.
That is not what this chart shows. The chart shows the effect of quantitative easing. That's what this chart shows. Because when you're buying treasuries from the market and retiring them, of course, the percentage of foreign and domestic holdings of publicly held debt is going to go down. So this last period, explain this X of QE. Explain it.
Sorry, I don't understand what you're saying.
This is a measurement of the amount of people that own treasuries. Is that right? Domestic versus foreign?
Yeah. So who owns? So as of December 22, there was 24
domestic
trillion.
I'm going to assume, because this chart is fucking worthless if it doesn't assume that the domestic holding, the gray bar that adds up to 100, doesn't include the Fed, which it must. And that is because the Fed has been buying treasuries from the market.
Okay, so let me just give you the numbers for a second, and then we can take out
No,
the Fed.
I'm just looking at the chart. The chart is a gray bar that says domestic holdings, and then there's an orange bar that says foreign holdings. You've had 10 years of the Fed buying treasuries.
I'm going to give you the numbers. There are $24 trillion of treasuries, publicly held treasuries outstanding. 7.4 trillion held in foreign hands. The foreign holding of publicly held debt between December of 18 and December 22 increased from 6.3 trillion to 7.4 trillion, while other investors increased from 16 trillion to probably 23 trillion. So, we're having to pick up the slack. Investment funds, private investors are having to pick up the slack because of foreign demand for treasuries lagging at this point. That's the point of the chart.
I don't know what to tell you. I think what this chart tells me is that the balance sheet of domestic holdings grows because the Fed has been buying treasuries. And in a world of QT, I suspect that this bar chart will change in the next 10 years. If you look at the histogram 10 years from now, if you assume that QT sticks around. So I don't know. You can interpret whatever you want to feed your anxiety. It doesn't change that there's a relative problem at hand, which is you cannot sell one thing without buying another. That's just the way it works in financial markets for these central banks.
The Federal Reserve, during that same time period, increased their treasury holdings. Here's the exact numbers. From 3.7 trillion to 9.7 trillion. So they bought 6 trillion of that debt.
I think the fact that we're going to go from quantitative easing to quantitative tightening over the next decade is another overhang. Because hold on a second, because not only does the U.S. government need to sell another 2 trillion of bonds every year to finance its deficit, which is basically the addition to the debt, you've got the Fed now shedding, like 8 trillion of bonds it already bought.
They're letting them roll off. They're letting them roll off and they're not reissuing them. But you actually said the right thing earlier, which is that the risk premium has been shrunk so massively between equities and bonds. These 2 trillion of bonds that these guys will issue, that between the strip will trade from 5% all the way down to, there'll be a line out the door. I guarantee you. And the reason why is exactly what you said before, David, which is why not own 5% paper from the US government? Versus having to all of a sudden speculate on the S&P 500 or something else. It's a no-brainer, and I totally agree with you. But this last 2 trillion, that'll be the easiest 2 trillion to sell. There will be a line out the door. Guaranteed.
Well, there's a line out the door at some price. So my point is that the yield will have to go up to attract those incremental buyers. And as the supply of T-bills becomes a glut, obviously they're going to have to make the yield more attractive in order to keep attracting that marginal buyer. It's just that simple. So yeah, at some price, they'll be able to find a buyer. But that yield will have to get higher and higher over time. And then that crowds out private investment. Because why in the world would you invest in a risky stock when you get 7% risk-free?
What's your alternative? Because again, what do you think the spread to JGBs is going to be if that's true? If U.S. Treasuries, if 30-year Treasuries are all of a sudden at 5.5, if Bill Ackman's right, which he could very well be. The other part of what he's not saying is what do JGBs look like? What do European bonds look like? You know what they're going to be? They're going to be trading at 300 to 500 basis points above that. It is cataclysmic for the entire world economy. And so we all move in unison. When we suffer, we will suffer less than other countries. And when we win, we will generally win more than other countries. That has typically been true. I suspect it will typically be true. And I don't see anything changing that.
Well, hold on. Let's assume that you're right. And what happens is that let's call it the Western world, and all these governments are basically mired in debts with a few exceptions. I guess Australia's good, Switzerland's good, but the rest have massive debt to GDP as well. So their bonds have to move up with ours. And so their risk premium has to go up as well. So you're right, in lockstep with the US. But now why wouldn't global growth just slow down across, let's call it this whole Western dollar complex?
Coupled with inflation.
Right.
Which is inevitable.
That's basically what's happened in Japan, right? Is that they have a 200% debt to GDP, and they've been very active in yield curve control. And so they've controlled the interest rates, but the price of that's been total economic stagflation
which is the
for 2 decades.
Decline.
They have demographic problems as well, but
that's the main issue there is young people there. There's just not a lot of young people there. I mean, the housing is crazy.